Good morning. We will pay attention to depreciation today. When a fixed asset is used, the value of the fixed asset will decrease every year. The value of the fixed asset decreases, writing off depreciation at the end of each financial year. Depreciation is the systematic allocation of the cost price of the asset over its useful life. So we will determine when we buy the asset how long we want to use the asset, and according to the useful life of the asset we will write off depreciation, so that we will write off an amount every year as depreciation that will reduce the profit in the income statement. If we decide that we want to use, for instance, the equipment for 4 years, then it means that we will have to write off 25% per annum on the cost price if we want to write off the total value of the asset over its useful life. So if I buy equipment at 40,000 Rand, it means that I have to write off this depreciation at 25% per annum. So I will write off the depreciation over a period of 4 years, so that the accumulated depreciation will be equal to the cost price of the equipment. The equipment is my positive asset. Assets increase on the debit side and decrease on the credit side. If I want to reduce the value of the equipment, I should reduce it on the credit side of the equipment account. But according to GAAP, we have to show the cost price of the equipment and the accumulated depreciation as individual figures on the balance sheet. Therefore, we open a separate account, accumulated depreciation on equipment, and this is my negative asset. These two accounts actually form a unit. The equipment is the debit side of my account, and the accumulated depreciation is the credit side of my asset account that will reduce the asset. If we decide to write off depreciation on the cost price at 25%, it means that we will write off at the end of 2013 the cost price of 40,000 times 25%, and that will give me 10,000 Rand. At the end of 2014, we will write off 10,000 again. At the end of 2015, we will write off an expense of 10,000, the same in 2016. So at the end of 2016, when we've used this asset for 4 years, the accumulated depreciation will be equal to the cost price that we originally paid for the asset. After we've written off the total amount, you can't write off any more depreciation. So even if we decide to use this equipment for a longer period than 4 years in the future, we will use it, but we can't write off more depreciation. So we will only be able to write off the depreciation until the amount for accumulated depreciation is equal to the cost price. At the end of the first year, we will open a depreciation account that is an expense. Expenses increase on the debit side, and we will debit the expense account with 10,000, and we will credit the accumulated depreciation account with 10,000 to indicate that the value of this asset now decreases on the credit side with the 10,000. In the income statement at the end of the first year, we will show that the depreciation for that year is 10,000 Rand. So that means that this depreciation account will be written off to the profit and loss account, and we will show it as an expense in our income statement. In year 2, we will write off depreciation again, and we will increase the accumulated depreciation account with 10,000 rand. And we will debit the depreciation account with 10,000. So it means that we create an expense in year 2 again for 10,000. We increase the accumulated depreciation. So at the end of the second year, the total accumulated depreciation will now be 20,000 rand. This accumulated depreciation will be taken to the balance sheet, deducted from the equipment. The depreciation is recorded in the income statement. So at the end of the first year, we will record in the income statement depreciation of 10,000. In year 2, we will again show the depreciation in the income statement as 10,000 rand. In the balance sheet, at the end of the first year, the cost price remains the same. So the cost price doesn't decrease. It remains 40,000. At the end of year 1, we've written off 10,000 rand depreciation. So we deduct the 10,000 and we say that the carrying amount, so what is this asset worth at the end of the first year, is 30,000 rand. In year 2, we will write off depreciation again, and we will credit accumulated depreciation. So at the end of the second year, my accumulated depreciation is now 20,000. The cost price is still 40,000. The accumulated depreciation is 20,000. So at the end of the second year, it means that this asset is worth 20,000 and the carrying amount is 20,000. We will transfer that 10,000 to the profit and loss account to close the depreciation account. At the end of the third year, we will write off 10,000 rand depreciation again. So we will increase the expense for depreciation on the debit side with 10,000, and we will credit the accumulated depreciation account with 10,000. So my accumulated depreciation now accumulated to 30,000. So this accumulated depreciation will increase every year until it's eventually equal to the cost price. This depreciation will be closed off, taken to the profit and loss account to indicate that the expense for depreciation in the third year is 10,000 rand. In the balance sheet, the cost price will still be 40,000 rand. The accumulated depreciation is 30,000 rand. So we will show in the balance sheet that the accumulated depreciation is 30. We deduct it from the cost price. So after we use this asset for 3 years, the equipment is only worth 10,000 because the carrying amount is 10,000. That means that if we use the cost price method, we will write off the same amount every year as depreciation because we use the percentage on cost price every year. The accumulated depreciation account will increase every year until eventually on the credit side it must be 40,000. In the balance sheet, we will not show the depreciation for the current year. We will show the accumulated depreciation. So the amount at the end of the first year was 10,000. The accumulated depreciation total amount written off from the day that we bought it until the end of the second year was 20,000. And the accumulated depreciation at the end of the third year was 30,000. So at the end of the fourth year, the carrying amount will be 0. The first method to use to write off depreciation is on the cost price. The second method is the diminishing balance method. In the diminishing balance method, we work on the reduced amount every year. So the first year, the asset is worth 40,000. We've written off 10,000 Rand depreciation at the end of the first year. When we want to calculate the depreciation for the second year, we will take the cost price of 40 less the 10,000 accumulated depreciation, and we will calculate the amount on 30,000 Rand. In the first year, we will calculate depreciation at 25%, and that will also give me 10,000 Rand. That 10,000 Rand will be written off to the profit and loss account as an expense to decrease my profits. So in the income statement, I will indicate that the expense for the year is 10,000. In the balance sheet, I will show at the end of the first year the cost price as 40,000, the accumulated depreciation as 10,000, and the carrying amount as 30,000. When we do the calculations, we've calculated for 2013 now that it is 10,000 Rand. For 2014, I will use the cost price of 40,000 minus the 10,000 written off up to the end of the previous year, and I will work out on the reduced amount 25% for 2014. So on 30,000 Rand, I will work out 25%, and that will give me 7,500 Rand. In 2015, I will take the 40,000 cost price less the accumulated depreciation for the first 2 years, that is 17,500, and on the reduced amount I work out 25%, that will give me 5,625. In 2016, I will take the cost price of 40, then I will add up all the accumulated depreciation for the first 3 years to work out what is the total amount that we've written off for the first 3 years, and that will give me 23,125. And I will subtract the total accumulated depreciation from the purchase date until the end of the financial year that we are recording, and I will work out 25% on that, and that will give me 4,219. If I look at these calculations now, I can see that every year the depreciation decreases. So the first year it was 10,000, second year 7,500, 5,625, 4,219. So because we are working on the reducing balance, we subtract the accumulated depreciation until the end of the previous year. This amount will decrease every year. At the end of the fourth year, when we worked out on cost price, the total accumulated depreciation was 40,000. Now the total accumulated depreciation is 27,344. So if you use the diminishing balance method, it means that it will take much longer to write off the asset. It will not only take 4 years. So if you want to write it off over a period of 4 years, you will have to increase this 25% to a higher percentage, for instance 40%. Otherwise, you will have to write off this asset over a period of 7 or 8 years before you will write off the total amount. In year 2, we calculated the depreciation as 7,500, So I will debit my depreciation account with 7,500 to increase the expense, and I will decrease my accumulated depreciation account so that this accumulated depreciation can increase with the depreciation at the end of the second year. Then I will add up this total accumulated depreciation to indicate that the total amount written off from the date of purchase until the end of the second year was 17,500. The depreciation account I will credit with 7,500 to close this account, and I will transfer this to the profit and loss account to reduce the profits. So in the income statement for year 2, we will indicate that the depreciation for the year will decrease the profits with 7,500. In the balance sheet, the cost price is still 40,000 Rand, but now the accumulated depreciation is 17,500. So I have to deduct the 17,500, and that means the carrying amount is 22,500. So at the end of the second year, my asset is only worth 22,500 Rand. In year 3, we calculated that the depreciation is 5,625. So I will debit depreciation with 5,625 to increase the expense on the debit side, and I will decrease my accumulated depreciation account with 5,625. This 5,625 in the depreciation account will be transferred to the profit and loss account to indicate that that is the expense for the current year, and in the income statement we will indicate that the depreciation is 5,625. In the accumulated depreciation account, we will add the figures and we will get a total of 23,125. So the 17,500 plus the 5,625 will give me 23,125. In the balance sheet, the cost price is still 40,000. The accumulated depreciation now is 23,125, and if I subtract that, it means that the carrying amount is 16,875. So the carrying amount is much higher than it was in the cost price method. What did we learn? The balance in the accumulated depreciation account increases every year with the amount of depreciation that's written off in for the current year, until this accumulated depreciation is equal to the cost price. After we reach the cost price, we can't write off any more depreciation, so you can only write off the cost price of the asset. The depreciation for the current year will be recorded as an expense in the income statement. The accumulated depreciation from the purchase date until the end of the current financial year will be recorded in the balance sheet. The carrying amount of the asset is disclosed in the balance sheet. That is asset less all the accumulated depreciation written off. When the cost price method is used, the same amount is written off each year until the cost price is written off. When the diminishing balance method is used, a reduced amount is written off each year until the cost price is written off. It will take much longer to write off the depreciation when the diminishing balance method is used.